Selling a rental at 63 can feel like freedom. No more repairs, no more tenant calls, no more late-night problems. After another maintenance call, George looks at Patricia and says, "I think we're done being landlords." That may be a perfectly reasonable retirement decision. But the tax return may tell a different story. The property has gone up in value. They have also taken depreciation deductions over the years, so the sale may create a sizable taxable gain. Around the kitchen table, the sale feels like relief. On the tax return, it may look like income. And 2 years later, Social Security may use that tax return when it decides whether IRMAA applies. IRMAA is an extra income-related charge that may be added to Medicare, Part B and Part D. George and Patricia are also thinking about a Roth conversion after the sale. The rental sale may make sense. The Roth conversion may make sense. The problem starts when several good decisions land in the same tax year. A rental gain, a Roth conversion, investment profits, interest, dividends, and other income can all stack onto one return. So this video is not mainly about choosing a Medicare plan. It is about choosing an income year. We will compare two versions of their plan, one crowded year and one more carefully sequenced plan. Then I'll give you a simple 3-part map to review before the closing date is locked in. This is education, not personalized tax, financial, or Medicare advice. Use it to start a conversation with your CPA, planner, or Medicare professional. For many retirees, Medicare planning starts before the Medicare card arrives. At 63, the tax return you are building may already be connected to premiums at 65. Social Security generally uses tax information from 2 years earlier to set today's income-related Medicare charges. That is why a rental sale can feel finished today and still show up in Medicare costs later. So let's keep this simple. We only need to understand a few income numbers. The first word to clear up is income. A retiree may think income means a paycheck, but the tax return counts much more. For IRMAA, the key number is Modified Adjusted Gross Income, often called Modified AGI. In everyday terms, that number starts with the income total on your tax return and adds back certain tax-free interest. It is not your net worth. It is not your account balance, and it is not the amount you spend each month. A rental sale can raise that number because part of the sale may be a taxable gain. The gain is not simply the check from closing. It can depend on the purchase price, improvements, selling costs, depreciation, and other tax adjustments. George and Patricia see the cash from the sale. Their CPA sees cost basis, improvement records, depreciation history, and the final taxable result. Depreciation is important because rental owners may have claimed deductions over the years, and that history can affect the tax result when they sell. Now add a Roth conversion. Money moves from a traditional IRA into a Roth IRA, and the converted amount is generally added to taxable income for that year. Then add profits from stocks or funds they sell after those investments have gone up in value. Interest, dividends, pension income, IRA withdrawals, consulting income, and deferred compensation can all push the total higher. Medicare does not hear the story behind each decision. It sees the income reported on the return. That is why a household can spend modestly and still report a high-income year. A one-time income spike does not always mean higher premiums forever, but it may still affect the premium year tied to that tax return. Here is a simple way to picture it. In a normal year, George and Patricia might show about $69,000 of income, roughly $48,000 from Social Security, $9,000 from interest and dividends, and an IRA withdrawal of $12,000. Nothing about that year feels unusual. Their monthly lifestyle is steady. Now imagine the rental sale adds an illustrative taxable gain of $180,000 to that same return. They may not be spending more each month, They may not feel wealthy, but the tax return can now show about $249,000. Before we even talk about a Roth conversion, now add an illustrative Roth conversion of $40,000. Then add an investment gain of $25,000. Together, the example income number rises to about $314,000. That is the disconnect many retirees miss. Lifestyle and tax income are not always the same thing. So when we talk about IRMAA, we are not judging how someone lives. We are looking at what the tax return reports. George and Patricia do not feel wealthy because of one closing. They feel relieved that the landlord chapter is ending. The disconnect begins when each decision is reviewed separately. The rental sale is one conversation. The Roth conversion is another. Investment changes may be a third. The tax return combines them. Several reasonable moves in 1 year can make the return look much larger than either spouse expected. This is where good planning can accidentally become crowded planning. Put those 3 moves together. A rental gain of $180,000, a Roth conversion of $40,000, and an investment gain of $25,000. Each move may have a purpose. None of those decisions is automatically wrong. But when all 3 happen in the same calendar year, they may land on one return. And that can push the example income number to about $314,000. That is why George and Patricia do not ask, "Is this a good move?" only once. They ask a better question. Is this a good move for this year? There is another disconnect. The CPA, the advisor, and the Medicare professional may each see only part of the picture. The CPA studies the tax result. The advisor studies the retirement plan. The Medicare professional studies coverage and premiums. IRMAA sits between those conversations, and the retiree often ends up carrying messages back and forth. But waiting for the Medicare notice can create a different problem. Once December 31st passes, many choices that affect that year's income are already finished. You may still have options later, but planning usually becomes harder after the year closes. That is why a review before year-end matters, even when the rental sale seems straightforward. An appeal can help in some cases, but it is not a reset button. Social Security recognizes specific life-changing events, such as retirement, work reduction, or loss of certain income. But not every income change qualifies. A voluntary rental sale by itself does not automatically remove the gain from the IRMAA calculation. If a notice uses wrong tax information, a corrected return, or a qualifying life event, read it carefully. Then ask which review option actually applies. Couples face one more timing issue. One spouse may start Medicare before the other, while both incomes still appear on a joint tax return. Patricia may reach Medicare first, while George still has consulting income, or pay arriving from an earlier compensation plan. One spouse can feel fully retired, while the combined return still shows a high-income household. Now let's compare 2 choices, one crowded year and one more carefully spaced plan. For George and Patricia, the breaking point is a leaking water heater during a family weekend. Instead of enjoying the visit, George calls a plumber while Patricia rearranges the day. The sale is solving a real retirement problem. They are not chasing a tax trick. They meet with a real estate professional and choose a likely closing window. Before they lock in the date, they ask their CPA to estimate the year's taxable income and tax bill. In their illustration, the estimate includes a taxable gain of about $180,000. It also includes the effect of depreciation claimed over the years. Then it adds selling costs and the other income already expected. The result is larger than they expected. At the same time, their advisor has discussed moving some traditional IRA money into a Roth IRA. That may be a sensible move. The question is whether it belongs in the same year as the property sale. They also expect dividends, interest, and a small amount of consulting income. Together, those items create a crowded income year. In their example, start with baseline income of $69,000. Then add a rental gain of $180,000. Add a Roth conversion of $40,000. And add an investment gain of $25,000. Together, that could push the income number to roughly $314,000. Here is Plan A. They sell the rental, report the gain, complete the Roth conversion, and adjust taxable investments in the same year. On paper, Plan A feels simple. Everything gets done at once. The rental is sold. The Roth conversion is complete. The investment account is adjusted. But the tax return may become crowded, and the combined income number may be much higher than either of them expected. In this simple illustration, roughly $314,000. If that return is later used for IRMAA, their Part B and Part D costs may increase. Now here is Plan B. They sell the rental. Then they review whether the Roth conversion of $40,000 or the investment gain of $25,000 truly belongs in that same year. Plan B does not mean delaying everything. It means not letting every taxable decision collide by accident. Let's compare the feeling of the two plans. Plan A feels clean because the calendar gets cleared. The sale closes. The conversion is done, and the portfolio changes are finished. But clean does not always mean coordinated. Plan B may feel less tidy at first, because some decisions are reviewed separately after the projected income is visible. In a simple illustration, Year 1 might stay near $249,000. Year 2 might be closer to $134,000. Plan B is not about avoiding every cost. It is about avoiding a surprise cost. For many retirees, the better plan is not the one with the fewest steps. It is the one with fewer surprises. That does not automatically make Plan B better. It may change the tax bill, investment risk, available cash, future IRA withdrawals, and Medicare costs. The right question is not simply, which year gives us the smallest tax bill? They need to compare total tax, future Medicare costs, available cash, and what they want retirement to feel like. George wants the rental gone before another repair season. Patricia wants enough cash set aside so the decision never feels rushed. That is a retirement life question, not just a tax question. For one couple, selling before winter may matter more than waiting for a cleaner tax year. For another couple, a short delay may be worth discussing. The point is not to force the same answer on everyone. The point is to see the trade-off before the papers are signed. George sees relief from tenants. Patricia sees more predictable retirement days. The tax return sees income, and Social Security may later use that return when it decides whether IRMAA applies. 4 views, 1 decision. Selling may still be the right move. The closing date simply needs to be part of the larger retirement income conversation. Before they choose the final sequence, they need 3 dates. They need the estimated closing date, each spouse's Medicare start date, and the tax year likely to affect the premium decision. Next, they need 1 income estimate, not a perfect number, just a realistic range that includes the sale and the other planned moves. Finally, they need 1 decision meeting. George and Patricia, their CPA, and their advisor review the same calendar instead of working from different assumptions. So before George and Patricia choose the final sequence, they put everything into 1 simple map. Here is the 3-part rental sale IRMAA map. Part 1. Map the years. Put the current tax year, the expected closing year, and the future Medicare premium years on 1 page. Add both birthdays and both Medicare start dates. If one spouse starts Medicare before the other, mark that clearly. Then identify which tax return Social Security is likely to use for each premium year. The general rule is a 2-year look back. always confirm the tax year shown on an actual notice. For example, draw 3 simple boxes: sale year, tax return year, and premium year. Place the rental sale in the first box. Then place the Medicare premium decision 2 years later, if that is the return Social Security uses. That simple drawing can make the timing feel much less mysterious. It also shows whether a Roth conversion, investment sale, or other income decision is trying to fit into the same box. Seeing the years together turns an abstract rule into a calendar you can actually use. Now the question becomes practical. What else is trying to land in that same box? Part 2. Project the income. For IRMAA Modified AG, I generally means adjusted gross income plus tax-exempt interest. Start with the estimated gain from the property and the effect of depreciation claimed over the years. Then add income likely to continue, pensions, wages, consulting income, interest, dividends, and rental income before the sale. Next, add the income decisions you may still be able to control. That may include Roth conversions, profits from selling investments, IRA withdrawals, business payments, or deferred compensation timing. Do not wait for a perfect number before you begin planning. A range can still be useful. One version may assume a gain of $150,000. That could create about $219,000 of total income. Another version may assume a gain of $180,000. That could create about $249,000 of total income. A third version may add the Roth conversion of $40,000. That could push the example to about $289,000 before any extra investment gains. The goal is not to predict the future perfectly. The goal is to avoid being surprised by a Medicare cost you could have seen coming. If the closing numbers are not final, use a reasonable range. A useful estimate now is better than a perfect answer after the year is over. Build at least 2 scenarios. Scenario A puts the sale and the other moves in 1 year. Scenario B separates some of them. Then ask the question George and Patricia almost missed. Does all of this need to happen in the same year? Sometimes the answer is yes. Sometimes it is no. What matters is knowing the trade-off before you choose. Part 3. Coordinate the decision. The CPA reviews the tax result. The advisor reviews the investments and retirement income plan. A Medicare professional can explain enrollment timing and how IRMAA may affect premiums. George and Patricia answer the questions only they can answer. When they want the property gone, what retirement should feel like, and how much uncertainty they can comfortably carry. A practical meeting can be very simple. George and Patricia bring 1 calendar, 1 income estimate, and 1 list of decisions that could still be moved, reduced, delayed, or confirmed. That gives every professional the same starting point. Put those answers and the financial numbers on 1 shared page. Keep the purchase records, improvement receipts, depreciation records, closing estimate, tax projection, and planning notes together. Schedule 1 review before the closing date, and another before December 31st. If the sale still makes sense and IRMAA is part of the trade-off, put the possible cost in the budget. Then move forward knowing what you chose. An expected cost feels very different from a surprise notice. Let's finish with a short action list based on your age and situation. If you are 60, 61, or 62, list the large income events that may happen before Medicare begins. Include property sales, Roth conversions, business payouts, pay arriving from earlier work, and profits from selling investments. If you are 63, ask for this year's income estimate before you add another major taxable move. Ask whether the return you are building may be used for your Medicare premiums at 65. For a 63-year-old, the useful question is not, can I sell? Of course you can sell. The useful question is, what else is landing in this same year? That question can change the conversation before the year is closed. If you are 64, review last year and this year before making another large income decision. You may not be able to change a closed year, but you can prepare for the cost and make the next decision with better information. If the notice arrives later, do not panic. First check the tax year, then the filing status, then the income number it used. In a simple example, that could mean tax year 2025, filing status married filing jointly, and modified AGI of $289,000. Many people react to the premium amount first, but the first planning move is to check the source of the number. Once you know the source, you can decide whether the notice is simply a cost to plan for or a number that deserves a closer review. Look for a corrected tax return, wrong IRS information, or an SSA recognized life-changing event. A voluntary rental sale is not automatically a qualifying event, so do not assume an appeal will remove the gain. Ask for help if you are unsure. The notice explains your review and appeal rights. Remember the order: year, income, decision. First map the year, then estimate the income, then decide which move belongs there. A high-income year is not automatically a mistake. The real risk is letting several income decisions collide without a plan. One shared calendar can prevent a lot of confusion. If you are thinking about selling a rental before or during your Medicare years, comment "rental" below. Here, we keep Medicare and IRMAA planning calm, clear, and easier to talk about. If this helped, like the video and subscribe to Tom's Medicare Blueprint. And before the income year closes, ask one question: will this income affect my Medicare premiums later? This is Tom's Medicare Blueprint, helping you plan simply, clearly, and with care.